Let's talk about the Basel III rules, which mandate higher reserve ratios for banks globally to ensure financial stability. It is a framework of banking regulations designed to enhance the resilience of the sector in the face of economic challenges. Developed in the aftermath of the 2007 and 2008 financial crisis, it focuses on strengthening risk management, imposing higher capital requirements, introducing liquidity standards, and addressing issues related to leverage and risk-weighted assets. The Federal Reserve has requested them to hold an additional 3% of depositors' funds for safekeeping. In July, United States regulators introduced Basel III Endgame regulations, aiming to raise capital requirements on large banks by approximately 25%. The changes will affect the whole sector, with at least $100 billion in assets, and would be fully phased in by 2028. The phased implementation suggests a slow adaptation to the new regulations. The delay raises questions about their current state and their ability to comply promptly. There is a significant and unprecedented collapse in the M2 money supply, with negative growth for 12 consecutive months, reaching around negative 9.33% in October 2023, which raises concerns about inflation and a recession. This is impacting small banks as people shift funds to larger institutions, affecting the entire sector. The gold's resilience and real estate price increases amid the money supply contraction. There are contradictions in the actions of billionaires selling assets and concerns about major stock indices. Challenges including over $680 billion in unrealized losses, and the national debt surpassing $33.7 trillion add to uncertainties. Major banks announced job cuts, and Moody's negative outlook for the global economic sector in 2024 indicates deteriorating conditions. The Federal Reserve's interest rate rises and balance sheet reduction contribute to the crisis, affecting corporate buybacks and causing liquidity issues in the repo market. The whole sector is collapsing, experiencing a larger collapse in 2023 than all of 2008 combined. The Federal Reserve's repo window is open to provide liquidity for an extended period, possibly indicating ongoing financial stress. The repo market is where banks can borrow and lend short-term funds. It has seen substantial decreases, dropping by $65 billion and $100 billion on separate occasions. Financial institutions, including money market mutual funds, utilize them to park excess cash, using Treasury notes to obtain the Fed's funds rate in overnight loans. The tightening lending conditions are expected due to both intentional actions and the aftermath of inflation getting out of control. The Federal Reserve's introduction of heightened initial margin requirements has resulted in reduced liquidity. The impact of these increased requirements on capital levels is causing concern with diminished capital to fulfill collateral demands. This scenario has potential to trigger a domino effect, prompting a fire sale of assets if they encounter margin calls from regulatory entities. The testimonies occurred during a Senate oversight hearing, where lawmakers questioned about harm to everyday Americans. CEOs of JP Morgan, Bank of America, Citibank, Goldman Sachs, along with others, expressed concerns to senators about the impact of proposed regulations. They are pushing back against proposed regulations aimed at increasing the level of capital needed to hold against future risks. They argue that these will negatively impact their competitiveness. During an annual Senate oversight hearing, CEOs sought to raise alarms over the impact of changes introduced in the Basel III Endgame regulations. They claim that the proposed regulations will raise capital requirements on the largest banks by about 25%. Jamie Dimon of JP Morgan specifically mentioned this figure during the hearing. They are opposing the proposal of holding an additional 3% of depositors' funds for safekeeping, arguing that it will hinder their ability to compete and lead to negative consequences for various sectors. They convey that the regulations are set to be fully phased in by 2028, suggesting a slow adaptation to the new capital requirements. They warn that these changes will make mortgages and small business loans more expensive and harder to access, which will harm small business owners, mortgage customers, and other borrowers. Moreover, these will have unintended consequences on everyday Americans, including pension holders, rural communities, and others. They suggest that heightened oversight will lead to more financial activities shifting to non-bank entities. Savings for retirement or college may yield lower returns due to increased costs for asset managers, money market funds, and pension funds. Real estate is grappling with challenges marked by diminishing prices and sales figures, indicating a significant downturn in the sector. The exposure of the top 4 banks to residential and commercial mortgage-backed securities stands at a staggering $719 billion, intensifying concerns. The Federal Reserve's gradual unwinding of only 10% of the $2.7 trillion mortgage-backed securities underscores the complexity within the financial system. The imminent requirement for corporations to refinance $2 trillion in corporate debt adds to the overarching economic problems contributing to a looming crisis. Additionally, the Federal Reserve of New York reports a substantial increase in household debt to $17.3 trillion, primarily fueled by mortgages, credit cards, and student loans. The housing market is experiencing a decline by 20% year over year, and existing sale numbers have plummeted to levels reminiscent of 2009, raising concerns about a crash. The situation is further exacerbated as end sales hit a record low, surpassing the depths of the 2001 financial crisis. Chicago Fed President Austin Gaby identifies housing inflation as a factor influencing the 2% inflation target. Addressing the decrease in housing prices will necessitate a significant rise in the supply of homes available for sale, linked to an uptick in unemployment. In 2005 and 2006, when loans became less available, fees and rates went up and the real estate market experienced challenges. The implication is that a similar scenario might unfold due to current economic concerns. The Federal Reserve's rapid interest rate hikes and quantitative tightening have led to increased mortgage rates, impacting affordability. Wells Fargo and Bank of America warn of a housing market recession. The tug-of-war between low inventories boosting prices and higher mortgage rates. Reducing them creates uncertainty. The current state of the United States housing market is marked by historical levels of unaffordability. The Federal Reserve's swift and unprecedented 19-month tightening campaign, involving a substantial rise of over 500 basis points in the overnight rate, coupled with quantitative tightening, where the Fed is shedding $15 to $20 billion monthly in mortgage-backed securities, has resulted in an excess supply. This surplus, with large mortgages available, has created difficulties for major investors, leading to increased risk premiums by lenders, thereby affecting home sales and demand. The United States faces a default cycle as corporate and commercial real estate loans mature, impacting borrowers through 2028. A significant housing shortage, especially in affordable options, poses challenges for the middle class. A looming technological shift will affect real wages, emphasizing the importance of housing security. There is a risk of property turnover, with institutional investors eyeing half of all single-family rentals, exacerbating the housing crisis. Inflation, fueled by extensive money printing, causes problems, especially as corporate debts readjust in 2024 and 2025. Defaults in corporate bonds and leveraged loans will lead to financial distress, risking job loss for around 19 million employees. New home builders resort to strategies like rate buy-downs, selling smaller houses and using cheaper materials to navigate the challenging conditions. Rising interest rates and reduced liquidity pose threats to the financial system. The future of mortgage rates is uncertain, with a delicate balance needed between stimulating the economy and controlling inflation. Projections for 2024 vary, with some economists predicting modest price increases and others suggesting declines. Monitoring local market data and factors like interest rates is crucial for informed decision-making in this complex real estate shift. October saw a 5.6% dip in new house sales. Builders, in response, are aggressively reducing prices and offering exceptionally low mortgage rates, creating distress in markets where existing sellers face challenges in competing. The affordability gap between new and existing homes is narrowing, with the median sale price of a new one only 4% higher than that of an existing one, which is a historically low premium. This suggests a need for a broader decline in prices and a reduction in mortgage rates to around 5 or 6% to attract buyers. At the beginning of the year, investors were worried about unrealized bond losses, which reached high levels by the end of the third quarter. The 10-year Treasury yields have decreased significantly since the start of the fourth quarter, positively impacting the sector. Credit conditions are more crucial than interest rates. Banks are well positioned for economic slowdown without reaching recession levels seen in 1990 or 2008 and 2009 in case the Fed stops raising rates. A soft landing combined with the Federal Reserve pause is anticipated to lead to meaningful performance in stocks. Hedge funds show rock-bottom exposure to financials, with banks being under-owned by the long-owning community. Concerns arise about the upturn in consumer delinquencies. Whether normalization leads to deterioration depends on the employment picture. The credit losses in the consumer sector hinge on the unemployment rate. They have already reserved for losses under the current expected credit losses accounting standard. If the economy experiences a soft landing or mild recession, the Fed is expected to cut rates aggressively. JP Morgan is noted as the top-performing stock in the current environment. Long-only investors are underweight overall. The unemployment rates have gone at almost 4%. In November, the number of unemployed persons was nearly 7 million, and the number of permanent job losers increased by 164,000 to 1.6 million. Additionally, the number of persons on temporary layoff is reported at 873,000. It is attributed to factors such as higher mortgage rates, default cycle, the overall economic challenges linked to this crisis, and fiscal deficits. The distress in corporations, particularly in sectors, is contributing to job losses, with an expectation that this trend will continue, impacting the overall market in the United States. The economic system in America is grappling with a multifaceted crisis characterized by financial instability, annual percentage rate challenges, and substantial losses. Provident National Corporation and JP Morgan Chase are closing branches due to economic difficulties, while Silicon Valley collapse exposes poor risk management. The Federal Reserve's aggressive interest rate hikes have led to struggles for regional entities, impacting the value of their assets. The increasing debt, credit rating downgrades, and decreasing consumer deposits contribute to a shaky confidence in the system. There are concerns about a recession, with differing predictions from economic institutions. Moody's downgrade of major United States banks reflects heightened risks to financial stability. The interconnectedness of the system raises worries about a broader crisis, and despite regulatory actions, questions persist about the government's role in addressing the situation. The global impact is evident as the finance industry recovers from the 2023 crisis, with ongoing uncertainties about risks in March 2024. Overall, the United States economy faces a complex array of challenges, prompting the need for comprehensive measures and heightened preparedness. The financial system is in trouble. Be prepared for the downturn by getting out of debt, improving credit scores, saving money, and learning about various aspects of the economy. Comment down below on what you think. And if you liked this video, please consider liking, subscribing, and sharing the video. Thanks for watching, and we'll see you in the next one.